There's a 23-year-old kid living in a studio apartment in Columbus, Ohio, right now, and 6 months from today, he will have turned $1,000 into just over $14,000. He will not do it by winning the lottery. He will not do it by inheriting money. He will not do it by some magic crypto token that goes vertical overnight. He will do it by understanding something that 97% of Americans refuse to accept, and that something is this. The financial system you're taught to trust was designed to keep you depositing, not compounding. Your savings account is paying you 4.5% while inflation silently eats 5%. Your 401k is locked behind a wall you cannot touch until you're 59.5 without the IRS punishing you for it. Your credit score, that sacred 3-digit number corporate America trained you to worship, exists to measure how good you are at being in debt, not how wealthy you are. And every single morning you drive to that 9 to 5 and trade the only non-renewable asset you have, your time, for a linear paycheck that will never, ever outpace the cost of the life they told you that paycheck would buy. So let me ask you an uncomfortable question before we go any further. If everything you were taught about money actually worked, why are 61% of Americans still living paycheck to paycheck in 2025? The answer is not that people are lazy. The answer is that the playbook is outdated, and the people who are quietly building real wealth right now are playing an entirely different game. My name is Godwin. Today I am going to walk you through, step by step, the precise strategy framework that allows an ordinary person with $1,000 and zero connections to engineer a path toward $10,000 in the next 6 to 12 months using high-growth equities, intelligent leverage, options mechanics, and a disciplined understanding of where asymmetric upside actually lives in the U.S. market right now heading into 2026. This is not hype. This is not a get-rich-quick fantasy. This is capital allocation at the micro level, and it is exactly what the financial media does not want you to understand, because the moment you do, you stop needing them. If you are the kind of person who values high-level financial clarity over surface-level noise, if you want to be inside a network that thinks about money the way the top 1% actually thinks about money, then you may want to subscribe to this channel right now. We are building something different here. Let us begin. I want to tell you about a man named Derek. Derek is not famous. You will never see him on CNBC. He works as a logistics coordinator at a warehouse outside of Atlanta. In March of 2024, Derek had exactly $1,100 sitting in a checking account at Bank of America earning essentially zero interest. He had no brokerage account. He had never bought a single share of stock. What Derek did have was a phone, a library card, and an aggressive willingness to stop being average. Derek opened a brokerage account on a Sunday night, funded it with $1,000 on Monday morning, and began doing something that changed the entire trajectory of his financial life. He did not gamble. He studied. He learned the difference between speculation and calculated risk. He learned that the U.S. equity market, despite what the fearmongers on Twitter say, has historically returned roughly 10% annually over the long run, but that within that average are individual stocks, sectors, and moments where the return profile is wildly asymmetric. He learned that turning 1,000 into 10,000 is not about finding one magic trade. It is about compounding a series of high probability, calculated positions where the upside dramatically outweighs the downside. And that distinction, that single mental shift, is the reason you are watching this video right now, and the reason most people will never do what I am about to show you. Let me set the framework. When you have $1,000, you're not an investor in the traditional sense. You do not have the capital to diversify across 20 ETFs and sit back and wait 30 years. That is a rich person's strategy applied to a poor person's account, and it does not work. What you are is a micro-capital allocator, and your single greatest advantage is something that billion-dollar hedge funds would kill to back: agility. You can enter and exit positions in seconds. You can concentrate capital into one or two high-conviction ideas without worrying about regulatory restrictions or liquidity constraints. You are small, and in this game, small is fast, and fast is how asymmetric returns are captured. But speed without strategy is just gambling. So let me give you the strategy. The first pillar is high-growth stock selection, and this is where most beginners destroy themselves before they even start. They go on Reddit. They see someone post a screenshot of a 400% gain on some microcap biotech, and they throw their entire $1,000 into a company they cannot even explain to their mother. That is not investing. That is not even trading. That is entertainment dressed up as finance, and entertainment is expensive. Here is what actually works. You need to identify companies in the U.S. market that sit at the intersection of three forces: sector tailwind, earnings acceleration, and institutional accumulation. Sector tailwind means the broader industry is growing, not because of hype, but because of structural demand. Right now, heading into 2026, the sectors with the most powerful tailwinds in America are artificial intelligence infrastructure, energy grid modernization, defense technology, and GLP-1 pharmaceuticals. These are not opinions. These are capital flow realities. Billions of dollars are being allocated into these sectors by the smartest money on the planet. And when the smartest money moves, it creates a current. Your job is not to fight the current. Your job is to find the smallest, fastest boat in that current and ride it. Earnings acceleration means a company is not just growing revenue, it is growing revenue at an increasing rate. A company that grew 30% last quarter and is projected to grow 40% next quarter has earnings acceleration. Wall Street systematically underprices acceleration because most analysts use linear models to project nonlinear growth. That gap between what the models predict and what actually happens is where your 10x lives. Institutional accumulation means that hedge funds, mutual funds, and pension managers are quietly buying shares before the broader market catches on. You can see this in the 13F filings that institutions are required to submit to the SEC every quarter. When you see 3 or 4 major funds initiating new positions in a small cap stock that has earnings acceleration in a sector with a structural tailwind, you are not guessing anymore. You are reading the map that the smart money left behind. Derek found a stock exactly like this. It was a small AI infrastructure company trading at $14 a share in April of 2024. It had a market cap under $2 billion. It had just reported revenue growth of 52% year over year, up from 38% the quarter before. And 3 well-known growth funds had initiated new positions in their most recent 13F filings. Derek put $500 of his $1,000 into this stock. Not all of it, $500. And this brings me to the second pillar, which is position sizing and risk architecture. The reason most people fail at turning small money into big money is not that they pick the wrong stocks. It is that they size their positions with emotion instead of math. When you have $1,000, you should never put more than 50% into a single equity position, no matter how convicted you are. Because conviction without a margin of safety is just arrogance, and arrogance in the market is the most expensive emotion there is. Derek put $500 into his high-growth stock. He kept the other $500 in reserve, and that reserve will become the most important $500 of his life. Because 6 weeks later, the stock pulled back 18% on a broader market sell-off driven by the Fed signaling that rate cuts would be delayed. Everyone panicked. Reddit was screaming that the market was going to crash. Derek did not panic. He looked at the fundamentals. Revenue was still accelerating. Institutional holders had not sold a single share according to the most recent filings. The pullback was mechanical, not fundamental. So Derek took $250 of his remaining $500 and added to his position at a lower price, reducing his average cost basis significantly. Within 3 months, that stock recovered and then surged to $28 on a blowout earnings report. Derek's initial $500 was now worth over $1,000, and his additional $250 was worth nearly $500. His total account had gone from $1,000 to roughly $2,100 in just over 4 months. Not $10,000 yet, but the compounding engine was now running, and this is where the third pillar enters the picture: options trading. Now, I need to be very precise here because options are the most misunderstood instrument in retail finance. Most beginners think of options as lottery tickets. They buy far out of the money calls expiring in a week. They lose everything, and then they tell everyone that options are a scam. Options are not a scam. Options are leverage, and leverage is a tool. A chainsaw is a tool. In the hands of a trained professional, it builds houses. In the hands of someone who has never read the manual, it takes off limbs. So, let me give you the manual. An option gives you the right, but not the obligation, to buy or sell stock at a specific price before a specific date. A call option increases in value when the stock goes up. A put option increases in value when the stock goes down. When you buy a call option, your maximum loss is a premium you paid, but your upside can be multiples of that premium if the stock moves significantly in your direction. This is a definition of asymmetric upside, limited downside, amplified upside. But the key, and this is where 90% of beginners get it wrong, is selecting the right strike price and the right expiration date. If you buy a call option that expires in 5 days, you are not trading. You are donating money to the market maker on the other side of your trade. Time decay, known on Wall Street as theta, eats short-dated options alive. Every single day that passes, your option loses value even if the stock does not move. This is why professional options traders almost never buy weeklies. They buy options with 60 to 90 days until expiration, because that gives a thesis time play out without theta destroying the position. Derek learned this the hard way. After his stock success, he felt invincible. He took $400 of his $2,100 account and bought weekly call options on a tech stock that he thought was about to break out. The stock went sideways for 4 days, and on Friday his options expired worthless. $400 gone in a week. Not because the stock crashed, because time killed him. Derek sat in his car after work that Friday and stared at his phone for 20 minutes. He told me later that it was the most expensive and most valuable lesson of his life, because it taught him the single most important rule in his entire game. Protect the downside, and the upside takes care of itself. After that loss, Derek recalibrated. He went back to his core strategy. He identified another high-growth name, this time in the defense technology sector, a company building autonomous drone systems for the Department of Defense. Earnings acceleration? Check. Sector tailwind with the U.S. defense budget expanding past $900 billion. Check. Institutional accumulation with 2 major funds adding shares. Check. But this time, instead of buying the stock outright, Derek bought call options with a 90-day expiration, slightly in the money, meaning the strike price was just below the current stock price. He allocated $300 to this position. Within 6 weeks, the stock had moved up 32% on a major contract announcement. Derek's $300 options position was now worth just under $1,400. A 300% return, achieved not by gambling but by applying the exact framework I just gave you. Sector tailwind, earnings acceleration, institutional accumulation, proper position sizing, and intelligent option structure with adequate time to expiration. By this point, Derek's account had grown from $1,000 to approximately $3,200 over about 7 months. And here is where the compounding math starts to become violent in your favor, because Derek now had enough capital to run 2 to 3 simultaneous positions using the same framework. He was no longer swinging at one pitch at a time. He had a portfolio, small but diversified enough to absorb a loss without being destroyed. Over the next 5 months, Derek executed 11 trades using this exact system. 7 were winners. 4 were losers. His win rate was 64%, which is not extraordinary by any measure, but his average winner was 2.8 times larger than his average loser. This is a concept that separates professional traders from amateurs. It is not about being right most of the time. It is about making sure that when you are right, you win significantly more than you lose when you are wrong. By month 12, Derek's account stood at just over $12,000. $1,000 to $12,000 in 1 year. Not by insider trading. Not by luck. By a repeatable, disciplined process of identifying asymmetric opportunities in the U.S. equity and options market. Now, I need to address the elephant in the room, and that elephant is penny stocks. Every single video about turning small money into big money eventually brings up penny stocks. And I'm going to tell you exactly what the financial media will not. Penny stocks, broadly defined as stocks trading under $5 per share and often under $1, are the single most effective wealth destruction tool available to retail investors. Here's why. Penny stocks have no institutional support. The companies behind them often have no revenue, no product, and no path to profitability. They are manipulated by promoters who buy shares at a fraction of a cent, pay for a social media campaign to create hype, and then dump their entire position onto retail buyers who saw a stock go up 200% in a day and assumed they were early. You were not early. You were the exit liquidity. The data on this is devastating. A 2023 study by the SEC found that over 72% of penny stock investors lose money, and the average loss among those who do lose is 64% of their initial capital. Compare that to the S&P 500, where historically, if you hold for any 10-year period, your probability of a positive return is over 94%. Penny stocks are not a shortcut to $10,000. They are a trapdoor to zero, and the reason they are marketed so aggressively is because the people marketing them need your money to fund their exit. There's an important nuance here. Not every low-price stock is a penny stock in a dangerous sense. There are legitimate small-cap companies trading at $4 or $5 that have real revenue, real products, and real institutional interest. The difference is due diligence. If you cannot find companies' SEC filings, if you cannot identify at least 2 institutional holders, if you cannot explain how the company makes money in one sentence, you have no business putting your capital there. Period. Let me bring this back to you. You are watching this video because you have $1,000 or maybe $500 or maybe $2,500 and you feel stuck. You feel like the system was not built for you. And you are right. It was not built for you. The American financial system was built to turn your labor into someone else's capital. Your 9-to-5 is someone else's cash flow. Your 30-year mortgage is a bank's 30-year income stream. Your credit card debt, carrying an average interest rate of 24% right now, is the most profitable product in the history of American banking. You were not taught how money actually works because if you understood it, you would stop participating in the structures that make other people wealthy at your expense. But here's the thing about systems. Once you see the architecture, you can use it. The same market that takes money from the uninformed gives it to the prepared. The same options chain that bankrupts the gambler funds the strategist. The same volatility that terrifies the passive investor creates the entry points that the active allocator has been waiting for. The question is not whether $1,000 can become $10,000. The math proves that it can. A series of 50% gains, compounded 7 times, turns 1,000 into 17,000. You do not need to hit a home run. You need to hit consistent doubles. The real question, the one that most people never ask, is whether you are willing to do what it takes to get there. The studying, the discipline, the emotional control when position goes against you, the patience to wait for a setup that meets every single criterion before you deploy capital, the humility to take a loss and learn from it instead of revenge trading your way into a blown account. I want you to think about where you will be 12 months from now. The Fed is navigating a complex rate environment. The U.S. dollar is under pressure from both domestic debt levels and global de-dollarization conversations. The IRS is expanding enforcement with 87,000 new agents, which means your tax strategy on capital gains matters more than ever. Short-term capital gains, anything held under a year, are taxed at your ordinary income rate, which for most working Americans sits between 22 and 32%. Long-term capital gains, held over a year, drop to 15% for most brackets. That difference in tax treatment can mean the difference between keeping $7,000 of a $10,000 gain or keeping $8,500. Tax awareness is not optional when you are building wealth from a small base. Every dollar you lose to unnecessary taxes is a dollar that cannot compound. Open a Roth IRA if you qualify. Contributions are made with after-tax dollars, but all gains inside the account grow tax-free and can be withdrawn tax-free in retirement. If you are young and your income is below the Roth threshold, this is arguably the most powerful wealth-building vehicle available to an American citizen, and most people ignore it because nobody taught them what it actually does. Let me leave you with this. Derek is not special. He did not have a finance degree. He did not have a wealthy family. He did not have any information that you cannot access from the same phone you are watching this video on right now. What Derek had was a decision. He decided that the story he had been told about money was incomplete, and he decided to write his own chapter. That decision led him to $1,000 invested in a brokerage account at a kitchen table in a small apartment in Atlanta. That $1,000 became $2,100. That $2,100 became $3,200. That 3,200 became 12,000. And the framework he used, sector tailwinds, earnings acceleration, institutional accumulation, disciplined position sizing, intelligent option structure, is not proprietary. I just gave it to you in this video. The only thing separating you from your own version of Derek's story is the decision to start and the discipline to stay in the game when it gets hard, because it will get hard. You will have losing trades. You will watch a stock you just sold go up another 40% without you. You will question whether any of this is worth it at 2 in the morning while your friends are asleep and you are reading SEC filings on your phone. And in those moments, you will either quit and go back to the paycheck-to-paycheck cycle that corporate America designed for you, or you will remember that the discomfort you feel right now is the price of admission to a financial life that most people will never have the courage to pursue. $1,000 is not a lot of money, but $1,000 deployed with intelligence, discipline, and a framework that respects risk while hunting for asymmetric upside is the most dangerous weapon a broke person in America can hold. Dangerous to the system that profits from your ignorance. Dangerous to the narrative that says you need to wait 40 years and hope your 401k survives. Dangerous to the version of yourself that was ready to accept a life of linear income and quiet financial desperation. You are not that person anymore. You watched this video to the end, which means you are already different from 95% of people who clicked on this and left after 30 seconds. Now, do something with it. Open the account. Fund it. Study the framework. Find your first setup. Place the trade. Manage the risk. And when that first position hits and your account balance shows a number you have never seen before, do not celebrate. Compound it, because that is how 1,000 becomes 10,000, and that is how 10,000 becomes 100,000. And that is how ordinary people in this country build extraordinary lives without waiting for permission from a system that was never going to give it. My name is Godwin. I will see you in the next one.